Hey everybody, good afternoon. Welcome to 12-Minute Trading. I'm Doc Severson. I'm joined with Dave Lukas here. Today is April Fool's Day, April 1st in 2024. And that's sort of how we're feeling about the markets today. Is we had a little bit of an exciting Friday, which there was nothing trading. I was really surprised to see that there was no Globex futures, nothing traded on Friday during Good Friday. And then not till last night, Sunday night, and then actually the futures went up, and then surprise, we
There's
are
your April
down.
Fool's
We're
joke.
down. Yeah, we're down 16 handles right now, and there's your April Fool's. So maybe this is some window undressing after last week's window dressing. So good afternoon, Dave. What are you seeing in the markets?
New quarter, new whole setup for the markets, right? We continue to be in an uptrend. I keep saying this, and it's interesting. We'll talk about the charts in a little bit. The daily chart on the S&P on the 9-day period has been pretty on it when it comes to like times where we're at, like right now. When it gets into an exhaustion zone, we get that pullback to that moving average inside the Bollinger Bands. And I said over the weekend that I expected to see that pullback this week. Whether we started there coming off the holiday or we got into it this week, I expected to see it because it's just almost like clockwork. Every time we hit that exhaustion, we just pull back to that moving average, we reset, and then we get going again. And today looks like it could be the beginning of that. And that would be about 5170-ish would be that range on the S&P that it would pull down to. Now, that's a key level I'd watch to see if it breaks down further from there. And if it does, that may tell you that we actually could be into that larger type correction that everybody's been waiting on for months on end now. But that pattern of breakout, walk sideways to down to the moving average, charge back up, breakout, it just seems to be happening like clockwork. And I just think we're in that phase of it where we walk sideways, pull back down to that moving average there, and then get ready to do it again. The other interesting thing in the charts is the daily charts are getting charged, or the weekly charts are getting charged back up again. So that's something that, we need to watch because they will create another large move out of that. And we could go either way. We could go down, we could go continue going up. But that would take things from here, 5,600 or so, probably at least. I mean, this weekly swing went, 1,000 points almost? So, I mean, we're getting ready for another weekly swing coming here in the not too distant future. So that's something to also be on the lookout for.
Yeah,
those are some of the things I'm seeing.
This is one of those really rare trends that we see every once in a while where it actually will recharge on the way up. I mean, we hardly ever see that, but look at this. We've got the chart charging back up again as it continues to go higher. And that's because it's like taking, 2 steps up, 1 step back, 2 steps up, 1 step back. And in doing so, it kind of recharges along the way. It winds the spring along the way. Now, we may yet get that final pump to the upside that nobody can believe. And then we may be in trouble after that, because we are going to be in a condition here where, we're going to have, like every time we've been down at this level, we've had at least a month or two of a little bit of difficulty here. Not a full trend reversal, but every time we get down to these areas, we are very susceptible based on some piece of news, some kind of, just about anything can happen.
And there's some things happening out there that I think are worth noting right now too. I mean, gold, pretty big jump over the weekend, and that's continuing in today. Oil continues to ratchet up higher. It's getting into, into the 80s and headed towards the mid 80s now. Treasuries and stuff are, moving up some. So you have to watch that. I did see today that now it's a less than a 50% chance of a Fed cut in June. So we started the year with 6 rate cuts. Then we've slowly gone down to just 3. And now they're saying, the Fed fund futures are saying, hey, maybe less than a 50% chance of a cut in June. Right. So, I've said, I'm on record here, the Fed, I think Powell has pivoted in the sense that he isn't going to raise anymore, even if inflation gets out of hand. They really can't. We're at $1.5 trillion in interest now on the debt. So it didn't take that long to get there. And it's hard for them to continue to just raise things. So they have to kind of just let inflation go because they're going to choose that over the debt, or having to deal with the debt, and that's just how the Fed's going to operate. Um, so you that's coming into play, I think, but the market hasn't really cared yet, and so we'll just have to see if it ultimately does. But as of now, it seems to just be okay with it, right? So still need a trigger, still need a bigger event to have any real major sell off.
Look at this amazing cup with handle. If you guys ever want to see what a cup and handle looks like, just look at like a gold or GLD, whatever you want to look at here for that.
Yeah.
This has clearly left the station, and the measured move target for this is really the depth, the entire depth of this. So it goes from 100, I'd say maybe up to 185 or so. So the breakout for this is going to be somewhere up near 270. Or 2,700 for the regular gold contract. So that's going to be that. That's going to attract a lot of attention.
Which a lot would argue that we should have been up closer to there for some time.
Yeah,
there's been a lot most people don't pay attention to the gold markets in the banks, but people don't know JP Morgan's been fined very big fines for their manipulation in the gold sector and other things and stuff. There's a pretty concerted effort, to really keep that gold price down because it's a sign that, the central banks have lost control, and if it gets out and it really gets too big, that's going to cause more panic and stuff, but there may be a point where they just can't contain it anymore. Maybe we're starting to see the beginning of that, but.
So I got a question here from Brewhead about cup with handle. There's, it's funny. You talk about cup with handle because really if you look at this is actually a fractal cup with handle. So in the context of a bigger cup with handle, there's actually a smaller cup with handle here. And so this has got a measured move target of this to the upside. That's going to be the initial move, and then eventually this whole move will play out. But we see this all the time. You get moves within moves that are mirror images of each other, just a smaller time frame and a smaller amplitude of that. So yeah, they're not going to be perfect. There's going to be no chart pattern which is exactly perfect like that. And, everything is more going to be an approximation, like a bull flag, how far, what kind of slope does it have to be a bull flag? It's more, I think what you eventually do is instead of looking at the patterns as like trying to match a pattern out of a book or something like that, what you'll eventually do is understand what's actually happening with the price discovery and the supply and demand for that asset and why the emotion behind it moves in the way that it does. That's more of what I'm looking for these things.
Yeah. And I mean, right now, it's interesting to watch this in gold. And again, this may not continue. Gold could get slapped back down. The energies across the board are getting closer to exhaustion on that chart. So there probably would be a pause or a pullback from there. But, central banks for the last few years have been hoarding gold. I know we talked about this in our mastermind. Gosh, what was it like was that our spring event last year when we were in Napa and stuff? We were talking about how, central banks were buying up more gold than they had ever on record, right? So the central banks have been doing this quietly behind the scenes, really buying up this gold and everything else and putting it in their stores, probably in a way to combat, some of the issues that we've seen with weaponizing the dollar and other things like what's happened to Russia and stuff like that over the last few years. And so, again, does that come to a head at some point and really start to break out and really start to maybe show the cracks in the armor of the U.S. dollar as a reserve currency? I think it takes a lot longer time, but gold breaking out is a sign that is happening. So let's see here. That's funny. Um, the other thing too, Doc, and you can talk about this, I think, is keep watching Bitcoin. Bitcoin's another signal around this stuff. I think it's holding around 70, looking like it's basing, maybe becoming a new support level for it.
Yeah, I'm just going to bring up the contract here, the BTC contract, just to stay on this platform. But it too is also showing a potential for a big rounded base and maybe a handle that's up here, because like everybody wants this to break higher up to 1,000 or 100,000, and everybody's like, hey, the halving is coming in 3 weeks, and so therefore we must have a rally. But honestly, guys,
I think if we come back first a little bit,
I'd love to see this thing just chop around for maybe 3 months or so, and just convince everybody to forget about it and say, oh, it's done, it's dusted, and then when everybody forgets about this, this will take off. It will take off, and right now I've got the measure move target up at 122,000 for this cup with handle. So we'll see if that actually happens. I think there's a good chance that we get much, much more than that. So Kathy Wood has now changed her target from 1.5 million to, I think the last was like 4.5 mil per Bitcoin. And that is the ETFs have made a dramatic impact on importing capital into this and creating a huge demand crush for this stuff. So it's, guys, we can only say this every weekend, but it's like, find a way to put in some kind of deposit schedule, even if it's $100 a week, $100 a month, whatever you have to do, just get a piece of this stuff. And, it's amazing. I've seen it around my family, like people that don't invest, don't have anything to do with it, all of a sudden have because, and we've talked about this before, like the only hedge against inflation is going to be to hold assets. That's the only way that you can combat, like the article that you brought up last week. Sorry, poorers. That's the way it is.
Yeah. And again, it's not because those are really going up in value. It's because the dollar is losing its value. I don't think people realize the dollar has lost 25% of its purchasing power since 2020. Okay. So literally in really just about 4 years, your dollar's worth 75 cents that you had 4 years ago. I mean, think about that for a second. Think about how dramatic that is. So, and it's how do you go broke slowly then suddenly? And that's why when you look at these charts of like the debt just going like this and screaming higher, it just goes, it's a snowball. It just goes faster, faster, faster. And that just, again, erodes the value, purchasing power of the dollar more and more and more. And that's why it's a trap. It's almost impossible to get out of. And they broke out of it in the 70s because we didn't have the debt and we were able to jack rates to 20%. You could buy a 30-year 18 to 20% CD. Think about that right now, all of you out there. If you were presented with like a 30-year 18% CD on your money right now, and you had $1 million, right? You throw it in there, it's like $180K a year for doing nothing, right? That's the type of stuff that existed back then, right? You can't get there today. They can't jack rates to that high because you can't afford to pay the debt. It'll crumble the whole thing. It'll crash it all down.
Yeah.
And so that's where the Fed is stuck, because the Treasury and, the current, let's just call it the current Congress, the current leadership is just going to keep spending $1.5 trillion deficits. And that's both parties. They're going to continue spending that money, and that snowball is going to keep going. The Fed, that's what's kicking the Fed's butt. If we weren't spending like that and we were, had lower deficits and we were maybe even just at even, let's say we were balanced, all the Fed had done would have really worked well, raising rates. We probably would have gone into more of a recession because the only thing propping it up is the government spending right now. We're spending like $1 trillion to have, a little growth in GDP, right? And so that's our issue. And that's just going to continue getting worse because you're in the trap now. So I talked about this last week, so you can go back and watch it. I don't want to get on that soapbox again, but that's it. So you have got to have your money moving, right? They call it currency because it's got to be in a current. It's got to move. Otherwise, it's worth nothing very quickly.
Well, they call that the velocity of money.
velocity of money.
Yeah.
You know, you have to keep your money moving at a velocity to keep up. If not, obviously, this is what happens. And that's why, like, there's something to be said. We talked about this last week. There's that upward bias in the markets over time. And the reason being is because the dollar keeps losing value. So markets will continue, yes, you'll have your pullbacks and your corrections and your bears in it. But over time, like you pull up that 20-year monthly chart, it goes up from left to right. And so there's something to be said. It just, buy 100 grand worth of the S&P 500 and let it go. There's something to be said for that investing strategy. In fact, what's his name's out there, the Wolf of Wall Street, that he's got a new book out, and that's his whole thing. He's just telling everybody, just buy the S&P 500 and hold it for 20 years.
What, Jordan Belfort?
Yeah. That's his whole thing out there right now. He's got a new book, and that's what he's pitching. Yeah, I mean, you just look at but you look at like a 20-year chart, and it's very glaring. It's a great, great picture of the value of the dollar eroding over time, So, yep.
Yeah, there we go. There's 20 years.
Look at that. And it's steepening and steepening because we keep going further into debt.
Yeah. Now, the one thing I did last week, and this is interesting, you guys might want to check this out. If you just go to a single chart, and this will take me a minute to put this together, but we've got the S&P 500, and what we're going to do is on the time axis, the price axis, we're going to go to a log scale. So we're going to apply this
now explain what that is for people so they understand what you're doing by doing that.
You'll understand in a second here. So what I'm going to do is now I'm going to go over to we're going to do max available, and we're going to do, we could even do a quarterly chart. How'd you like that? We can do a quarterly chart. Okay. So this is the S&P from when it was $4.4 a share back in 1932. All right. So that's kind of the bottom of the crash that we had back then. So it's $4 a share for the Standard & Poor's 500. And so what you'll see is that this smooths out all of this, because what you need to look at here is the vertical scale. So this is a logarithmic. So instead of the chart going like this, what the scale is doing that, and it normalizes everything out. And so actually, if we look at things, and life is logarithmic with the way that we're treating the money, and this is always going to happen. So, today we're looking at a 4,500, 5,000 print on the S&P 500, and we're going to laugh at that someday and say, man, I remember when it was only $5,000. Now it's $100,000 for the S&P 500.
Well, and think about this. I don't think people realize, like, back in even like 2020, right? The NASDAQ was at like 9,000. We were talking about like 8,000, 9,000 on the NASDAQ just a few years ago. Hey, you could maybe pull up the NDX in that too and just, show it. But like, that's how fast things are happening.
Okay. So here's something that might be interesting here. So if we do this, if we're still on our, our graph here, and this is still going, did it go? Yeah, I think, hang on a second. Let's make sure it's still, yeah, we're still in the log scale. I don't think it likes it when so what I'm trying to do, is to extrapolate here.
Extrapolate where it's going to go. Yeah.
Right. So if we do something like this, we're going to be, I think it's going to be much, much more than that. So this is not.
Well, I think it's going to go at a much steeper rate.
Yeah, it's going to go at a much steeper rate than that. And unfortunately, I can't really. Well, here we go. Okay, so it's going to be. So if we just do something like that, we're dealing with, a few years from 20 years from now, we're going to be dealing with an S&P 500 at maybe 50,000.
Yeah, that's 20 years. I mean, so that's why I said there's something to be said about just having a portion of your portfolio. And that's kind of the thing with Bitcoin too, over time, because of the finiteness of it. Brew had made a couple comments too, just real quick to get to those. Silver's a good point. Silver, if you're looking at gold and silver, silver's maybe even a better buy because the ratio of gold to silver historically is not in line. Silver has a lot of catching up to do. I think it should be at like $70 an ounce if it was to catch up to where gold is. So that's something to think about. And it has been moving recently as well too. What else would you own other than assets? Just curious what you think the alternative is. Well, I mean, so anything that's tangible and has value. Why did like all of a sudden when COVID hit and stuff did all these things like fine art and baseball cards and fine wines and that stuff start to really go up in value and people like the wealthy scrambling to buy those? They do that because you're debasing the currency further. And so those things, again, they're finite. There's only maybe one or two or three or whatever it is of those different things, right? There's a vintage of wine. There's only so many bottles and so on. And so that holds the value over time. And if the dollar goes down, those go up in value, right? So there's a lot of that type of stuff out there. There's companies now where you can buy into. I actually Masterworks. I know the guy who founded Masterworks, and he's killing it. And they're doing really well. You can buy a piece of a $10 million painting, and they hold it for a time, and they sell it, and you get the difference on it. And they're returning like 16%. In a lot of cases, it's nice. I think he timed it really, really well with that company. There's obviously real estate is going to look at real estate. I mean, I just was having this conversation the other day with, someone that I know that was looking to build a house, right? Now we built a house and we finished in 2019. We got pretty lucky, honestly. We didn't know COVID would hit, but we got lucky and we built, the house we wanted to build with everything that we wanted in it and all that stuff. And we probably averaged here in Ohio less than $150 a square foot. Okay. Nowadays, it's 300 to 400 a square foot to build here in the same area, right? Just a few years later. So, I mean, you got a new floor set under real estate. So real estate continues to go up over time. And if you know how to own and manage rental property so that it cash flows, you can do really well. There's other things that you can do though, where you can buy into, different arrangements where you can get a K1, you can own a piece of that property and it's managed and everything else, and you get a return from that. We've got things in our mastermind group that we invest in, that own class 1 properties and things like that. Oil and gas is another place. We invested with Phoenix. So if you've never looked at Phoenix Capital, we do some things with them that are special for the mastermind group, but a normal person can go buy one of Phoenix bonds, without being a credit investor and everything, and get 8 to 10% on your money. Those guys run a nice ship. They run a nice business. So there's a number of different things out there. And I think it's good to, quote unquote, diversify in the sense that you've got, maybe some real estate, maybe some oil and gas, maybe, obviously some Bitcoin, you have the market, you trade options, you kind of spread how you do it across things. And that builds a nice balanced approach to it, but you're owning assets, right? And that sort of thing. So, Doc, I don't know your thoughts on that, but
I think what is going to be one of the coolest investment vehicles going forward, I'd say over the next 5 years, is that everything is going to be tokenized. So think about it this way: you can
BlackRock's doing it now.
You can set up a token for anything of value right now, and then you can set up that token for sale. I mean, at some point, maybe Dave, you're going to tokenize yourself. And you're gonna, you're gonna take investment in and say, "Hey, bet on me," something like that. So we now have the blockchain. We now have the vehicles for being able to do something like that. And I mean, I remember when I was younger, it's like I'd follow bands around, and I'm like, man, I know this band is going to go somewhere. I know these guys are going to be big, and there was no way you could do anything about it and say, "Hey, I'm a fan." And now you can, pretty soon, I think you'll be able to invest in just about anything that you want to. You can vote with your feet on that stuff. So
Well, and
What?
there's versions of that already happen. Like you'll see this. I mean, you see this now with just like podcasters and things like
Yeah,
that, where you can pay to be part of their inner circle. You know, like
right,
Tucker Carlson Network is an example of effectively tokenizing yourself in your own network. Just pay to be a member, right?
right.
Things
Patreon
like
stuff.
that.
Yeah,
You know, the Blaze, other things like that exists out there. But just about everybody's got some sort of premium model, right? And that's early tokenization in a sense, right? So that's another thing that you're going to see. One of the things that I'm would and I I really toyed with figuring out a way, going back in, getting some big investment together to go after this at some point is your data, because all of these companies, Google, Facebook, all the social media, you are freely giving them their product. Their product is you, it's your data. All they're doing is they're taking your data and they're using it to sell you things, as well as packaging up, selling it to others, and they're freaking amazing at it, right? But what if there was a way for you to own your data and you would only share it with these companies if they cut you in on that revenue? I think there's something to be said for a solution like that in the future. Um, it's going to be tougher because we're so far down the pipe that everybody's using these platforms freely and all that type of stuff. It would have been better if you created something when it first started to take off, but I don't think we realized how much of value our data has. Data is like the new oil, honestly.
hmm
So there's something to be said for data, and then you have the whole AI. When AI really actually becomes truly effective and usable in things that I don't think we're there yet, but when that happens, that's going to be in a whole nother part of it. So, there's a lot out there, right? But I always say that if you don't understand it, if you don't understand it or can't understand it, don't invest in it. So just remember that.
That's one of the 5 rules of gold from the richest man in Babylon.
Yeah. Yep.
Yeah. So, does anybody else have any other questions for us today? So we're running a little, just about out of time here. A couple of minutes left. If there's any final questions or anything else. So other than that, we continue to run our fund. We continue to run our trading rooms, and we're doing great with that. So if you're out there, if you're looking for any kind of direction, please let us know. We're certainly willing to help and
Yeah,
get you
in
pointed
fact,
in
we
the right
don't talk
direction.
about it much, but if you haven't checked out our master classes, for $97, you get a full-on master class A to Z on like fractal energy or the campaign strategy or, $100 a day. We've got these different ones. Check those out. Doc's done a really good job with them over the years of really putting these things together. And it's a great way to really teach yourself and go at your own pace and stuff like that too. So we need to probably tell people more about those things. You can find them right on our website at 12 Minute Trading, but those are some great resources for people for very much nothing.
There is a very narrow path to success, and like everybody thinks that they can get there through the old techniques that work for them in business or their career, and unfortunately it doesn't work that way. The market has very, very different requirements for you to succeed, and the first thing you have to do is to learn to think differently, especially about risk. So everybody comes into the market thinking about risk is a bad thing, like stay away. And no, you absolutely have to embrace it. You have to be able to define it, embrace it, accept it. And those that are unwilling to do so and are still looking for, something where the Holy Grail strategy, where you have no risk and you win every time, will not be in the business for too long. So we've been there before. We've walked the path. If we can help, let us know.
Cool.
All right,
Awesome. Well, if
guys.
there's no more questions, yeah. Thanks, everyone.
Thanks, everybody. We will see you in the next session, probably next week. All right. Adios, folks. See you around.